Trump 2.0, Powell and their impact on the US markets, India Inc.'s lackluster Q2 earnings, and why I continue to avoid FedEx. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast, recording from my office here at Brunel Business School, Brunel University, London, Brunel University of London. We did have a name change. Right. Where do we start, guys? Where do we start today? Who saw that coming? Be honest. Who saw that coming? You know what I'm talking about. If you indeed saw the results of the US elections coming, then I really hope you made some money in the betting markets like the mysterious trader did. I think he put a 30 million wager on Trump winning, and he's now on track to earn or I think he's already won in excess of 50 million. So if you really saw the election results coming, I didn't. I'm going to be very honest with you. If you really did see it coming, I really hope you made some money in the betting markets, because like I said, I did not expect that. And I've talked to a lot of the hot topic in my office, hot topic among my friends is all this. Nobody saw this coming. I mean, I honestly think it's time pollsters find another profession, or we just kind of retire the whole profession of pollsters, because it's been a bad year for them. Let's be very honest. This exit poll or whatever it is, oh my God, I don't know where to begin. Pollsters in India got it wrong on multiple occasions this year, as you very well know, with the Indian elections and then the state elections. They got it wrong there. But the magnitude by which US pollsters got it wrong was frankly embarrassing. The 2024 US election was not a close fight. It was a knockout of epic proportions as far as I'm concerned. What was expected to be an event whose results were not supposed to be known for days ended by 2 a.m. Eastern time, 2 a.m. New York time. I mean, I know, because I actually managed to get some sleep after thinking I would be doing an all-nighter. I had a meeting in the afternoon. I was like, oh my God, I'm going to go into the office completely sleep deprived. No, I actually managed to catch them because the results were done and dusted. When the dust settled, Donald Trump decisively won the election and can call himself the 47th president of the United States of America. What a turnaround story it has been for that man. Whether you love him, whether you hate him, gotta admit, it's been a turnaround story. This is not a political show, so I'm not going to dive too much into it about where Democrats failed, where Republicans won, all of that. That's a different channel, different show, not this one. All I will say is that the US markets were in absolute euphoric mood as the prospects of lighter regulation, greater M&A activity, and more emphasis on domestic manufacturing took all three indices to new highs. And then there was the Fed, who did exactly what they were supposed to, exactly what everyone expected them to do, and they did exactly that, and the markets rejoiced even more. Once the dust settled, all three indices decisively ended in the green, with the Dow even managing to top 44,000 for the first time ever. Who saw that coming this year? Yeah, for the week, and the S&P 500 also touched 6,000 briefly for during Friday's session. So who saw that coming at the start of the year? It's a case of who saw that coming, right? For the week, both the Dow and the S&P 500 capped their best week in a year, both jumping 4.7%, and the tech-heavy NASDAQ jumping 5.85%. So, ladies and gentlemen, let me welcome you to the first segment, Doctor's Weekly Snapshot, and take you through a week in the US markets that no one saw coming. Like I said before, never in my wildest dreams did I think about the election results, but also never in my wildest dreams did I think I would hear Wall Street dub the November Fed meeting as boring. You are talking about the Federal Reserve here. Yeah, the Fed meeting has been on the forefront of investors' minds regarding the interest rate hikes, but the election results and the subsequent implications was so much that Wall Street analysts actually called November's Fed meeting, and not just analysts, a lot of investment managers said, meh, it was just boring. I mean, it's crazy how you think about it, like how perspectives have dramatically changed since the elections have, since the election results have come out. And believe it or not, all these fund managers and analysts have a point, at least from a market's perspective. And it's not because the Fed, by announcing a 25 basis rate cut, did exactly what everyone was expecting. This has happened before. In fact, with the exception of the September meeting when the Fed announced a massive 50 basis point rate cut, every other meeting since around late 2023 has been very predictable. Let's be very honest. If the odds of a pause were higher than 70%, then that's exactly what transpired in the past. Like if everyone really thought the Fed was going to pause and no rate hikes, no rate cuts, then that's exactly what transpired. So this has nothing to do with the 25 basis point rate cut. Everyone saw it coming, and I'm not calling it boring because everyone saw it coming. It has everything to do with the US elections and the potential benefits for the markets from what was a resounding and thumping victory for Donald Trump. Let me give you some proof. Following Trump's victory, the market cap of US stocks, according to the Wall Street Journal, rose by $1.62 trillion on Wednesday. One day, single day, $1.62 trillion. Fifth best one-day showing ever, as in history. Although everything rallied, the potential beneficiaries rallied even more. These include the banks, because obviously of the potential deregulation, prospective M&A boom, with Wells Fargo jumping 13% to an all-new all-time high, and the likes of Goldman Sachs and Morgan Stanley jumping more than 10%. The 7 largest US tech stocks added a collective $475 billion in market cap, thanks to the potential deregulation of AI and the prospects of an M&A boom. Animal spirits, as they say, it's coming back. So the big tech basically collectively gained $475 billion in market cap. And small cap stocks, because of the prospective domestic manufacturing boom, because Trump calls himself the tariff man, and because of that, small cap stocks had a great day as well following the election, with the Russell 2000 marking the best day in nearly 2 years. Russell 2000, I don't talk about it much on the show. It is the small cap index. Overall, the Dow Jones, following Trump's decisive victory, ended Wednesday with the biggest gain in 2 years, jumping 1,508 points. Let that sink in. The Dow on Wednesday jumped 1,508 points. I mean, these are absolutely mind-blowing numbers. The S&P 500 had 2.5%, and the tech-heavy Nasdaq rose 3%, as deregulation, tax cuts, increased M&A activity all drove markets to euphoric highs. And no company's investors benefited more from the election results than Tesla. For all reasons. You know the reasons already. I mean, Musk was a big supporter of Donald Trump. The Tesla stock soared more than 14% on Wednesday and followed it up with massive gains in the subsequent 2 days, ending the week with a little over $1 trillion in market cap. The prospects of Elon Musk gaining an all-access pass to the Oval Office, and with it the potential to influence lighter regulation on autonomous vehicle testing and driving, was more than enough for investors to send that stock skyrocketing. To give you some context, Tesla is just $7 away from a new 52-week high, and only a fool would bet against the company setting a new record by next week. I do really feel sorry for the Tesla shorts. Their fundamentals go against the company, but who cares about the fundamentals these days when it comes to Elon Musk? I have to give it to Elon. He took a massive gamble, put his money where his mouth is, and is now set to reap a lot of rewards handsomely. Hate him all you want, Elon always seems to have the last laugh. I mean, I'll probably get some nasty responses after this episode gets out. I'm getting ready, I'm geared up, but it is true. Believe it or not, I mean, hate him or not, it is true. Right, where was I? Oh yeah, the Fed. Amidst all this euphoric activity, I almost forgot. We also had the Fed. You see how easy it is to forget that we had a central bank meeting also this week? When is the last time, right? Every time you see my shows, I talk about the Fed constantly and almost forgot. Oh yeah, got to talk to you guys about Fed. Such has been the madness that I almost forgot. Okay, let me remind you once again that the Fed, as expected, cut 25 basis points last week. And unlike last meeting, this time the vote was unanimous. When the Fed cut 50 basis points, there was one dissenting vote. The first time that has happened in years. But this time it was unanimous. Everybody on the Federal Reserve said, you know what, we're going to get 25 basis point cut. And that's exactly what happened. If you look at the changes in the Fed statement, it shows a central bank that is largely relaxed with where inflation and the labor market are. For instance, the latest statement replaced job gains have slowed with, since earlier in the year, labor markets have generally eased. I mean, it's a little bit more positive tone, isn't it? Which is just a more calmer tone, may not be positive, but a calmer tone than last time. Furthermore, the statement also replaced, the committee has gained greater confidence that inflation is moving sustainably towards 2%, with the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Once again, this suggests that the emphasis has shifted from worrying on labor market to having a very confident feeling about the direction of both the labor market and inflation. And because I love doing this and because I'm preparing to teach this to my students in my next lecture tomorrow, I decided to do a sentiment analysis on the Fed statements, both the September and November ones. Surprisingly, the analysis found that the September statement had a marginally higher positive sentiment compared to the number one. I'm talking about November one. I'm talking about like marginal, 0.15 for September versus 0.12. Still important, but marginal, I would say. This is despite the September meeting having one dissenting vote. My conclusion is because the rate cuts was 50 basis points and because the Fed was hyper bullish on inflation's direction, the tone came across as more positive in September compared to November. Furthermore, the analysis also showed that the November statement was actually more objective compared to the September one, which demonstrates how measured the Fed is, how relaxed the Fed is today now that the labor market conditions are not as bad as initially feared. Did a bit of sentiment analysis for you guys anyway. I'm teaching the students tomorrow anyway. Might as well get some practice out of it. Anyway, despite a more measured tone and despite doing exactly what the markets wanted, post the release of the Fed decision, markets just shrugged it off. Markets did rise, but it was nowhere near the euphoric reaction we got post-election results. It was a case of whatever, bro, rather than, yeah, let's go, Fed 25 basis. Yeah, there was no euphoric reaction, bro. It was like, okay, whatever, 25 basis point, fine, Fed, who cares? I'm not even joking. I'm making this. I'm not making this up. It is that was the attitude. Have you ever seen that happen after the Fed's decision? This is why I have to keep telling you. I'm not joking. I'm not making this up. The reaction was exactly like, okay, whatever. And if you talk to the fund managers, if you listen to fund managers' interviews as well, same story, whatever, 25 basis, let's move on. Let's keep buying stocks. Even the press conference by Jerome Powell was like, meh, except for some spicy sound bites from Fed Chair Powell when asked if he would resign now that President-elect Trump is entering the White House. He answered no, but not exactly no, but there was some very spicy sound bites, might I add. I'd urge you to check the press conference of Jerome Powell. Obviously, I can't show it to you here, but essentially, yeah, except for that, it was like, whatever. Despite the market's whatever reaction, the Fed still has a lot on its plate now than before, especially since Mr. Trump has planned to cut taxes, import massive tariffs, and raise the deficit. As things stand, President-elect Trump is inheriting a U.S. economy that is on solid footing. Last week, I told you the GDP data was about 2.8% year over year. It grew 2.8% year over year. And as things stand, both inflation and the labor market are heading in the right direction, more or less. The idea of a recession is out of everyone's minds. However, declaring complete victory will have to wait. The idea of a soft landing has actually led to higher borrowing costs for companies and households in recent weeks, according to the Wall Street Journal. Furthermore, mortgage rates have refused to fall. They jumped to 6.8% this week from 6.1% around the time the Fed undertook its rate cut of 25 basis points. Given that, and this is because mortgage rates are actually more closely linked to treasury yields than Fed's interest rates. And yields have been jumping. They have been jumping under the premise that President-elect Trump's tax cuts would add to the already ballooning fiscal deficits, and his tariffs would get inflation rising again. So under that threat, yields have been jumping, and this is why you see the mortgage rates refuse to fall off despite Fed chopping off rates one meeting after the other. The second part in particular, with the inflation rising again, the tariffs, the threat of tariffs on rising inflation, that will cause headache for Powell and company, especially since they've somehow managed to tame nobody gave them any, credit. I should give them the credit. Nobody expected them to tame inflation, but they have somehow managed to tame inflation. And now there is the threat that tariffs could raise inflation again. When asked about the Trump administration's potential policies, Fed Chair Powell said it's too soon to say what the policies would be and how it would reshape the economic outlook. He's not wrong. However, he doesn't have much time to figure out, left to figure out. Mr. Trump is going to get going soon after he takes the office, obviously. All eyes will now be on the December meeting because we will get clues as to what the Fed thinks about the next administration. As things stand, the CME Fed Watch tool data shows a 64.5% probability that the Fed will undertake a 25 basis point rate cut in December. But given the specter of rising inflation looming large, don't be surprised if the Fed does nothing in December, especially if unemployment remains low and labor market conditions improve between now and the next meeting. The only question, ladies and gentlemen, is whether markets will still be hungover from the election euphoria and actually pay attention to them, or whether it will be yet another case of whatever, bro, in December. On that note, I am going to welcome you to the next segment. We are going from US to India. Welcome, ladies and gentlemen, to the Dr. Goes Home segment. Right, a lot of euphoric talk. Not so euphoric in Dr. Goes Home, unfortunately. So, I was debating which area. Okay, this week I was debating which area to talk to you guys about when it comes to the Indian markets. Do I do automakers? Do I do banks? Do I talk consumer goods? I mean, these are all relevant investments in the field. So I've got investments in them myself. So I didn't know which area to pick. But when you actually look at the overall picture today, then if US markets are actually cruising, Indian markets have been painting a completely different picture altogether. So I thought I would talk about the Indian markets in general and why there is no need to panic, actually, in my opinion. But more on that later. To say that investors may have soured on Indian markets may be an understatement, to be brutally honest with you. At the same time, I continue to believe that the long-term India growth story remains as solid as ever. So I thought instead of focusing on one sector, why not take you through what's been happening with the Indian markets? So first, the big picture. In the last 1 month, S&P 5, the Sensex, keep talking about the US, now we'll be back to India. The Sensex has been down 2.43% and the Nifty has been down 3.34%. If it weren't for some boost through the US elections, the extension of the boost through the US elections, then the week gone by would have been an absolute nightmare for the Indian markets. But overall, both Sensex and Nifty managed to eke out minor gains for the week, 0.78% for Sensex, 0.3% for Nifty, marginal to say the least. So then the question becomes, I gave you the big picture, the question then becomes on your mind, if you're an investor, especially if you've invested in markets, what is driving this lack of interest in the Indian markets, especially when the country is considered to be the world's fastest growing economy? Well, to be honest, there are a multitude of factors, but what I particularly like, and I said like, okay, keep that in mind, about this pullback or correction, this is why I said like, I didn't get that wrong. I said what I like about this pullback or correction is that investors in Indian markets have become more and more rational than in the past. Let me explain to you what I meant by that, okay? And let me explain to you my logic to say why Indian investors are becoming more and more rational. Why do you invest in a company? You invest in a company when it has strong fundamentals, and one of the key fundamentals you're looking for is strong earnings growth. What happens when the earnings growth slows down and the valuation of the company is priced for perfection prior to the slowdown in earnings growth? Obviously, you're going to take profits because the existing valuation is no longer perfect. Either so when I say it's you're going to take profits or you're going to sell the shares completely because it's not perfect. Rational logic, right? Rational logic. Well, then that's exactly what's happening in the Indian markets right now. It's not rocket science level thinking, no irrational behavioral trends, nothing. Earnings growth has slowed down, love is gone, no emotions, just logic. Let me give you some context. Of the Nifty companies that have reported so far, 34 of them have showed zero, and I mean zero earnings growth according to Economic Times Markets. That's right, flat, 0% growth on a year-over-year basis. What's worse, the expectations on average were a mere 2% growth anyway, and they haven't even met that. In other words, the Q2 earnings season have been much worse than feared, which has led to this correction. Motilal Oswal, in its interim earnings review, mentioned that the FY25 EPS estimate for Nifty has been slashed by 1.2% to rupees 1,059, owing to poor showings by some of the heavyweights such as Reliance Industries and Coal India. What's worse is that the estimated EPS for FY26 was further slashed by 1% to 1,256 rupees from 1,269 rupees on account of an earnings downgrade for companies such as Reliance, Maruti Suzuki, and Bajaj Finance. You see the logic now. Earnings growth degrading, slowing down, earnings downgrade. Clearly, valuation is no longer priced for perfection because it is not perfect. Investors selling. As simple as that. No rocket science there. Earnings slowdown is not limited to the companies, a list of companies I mentioned just before. Across a multitude of sectors, Q2 performance has been simply lackluster. You take the FMCG sector, thanks to subdued demand in the urban areas, numbers came in much lower than expected. The sector simply cannot catch a break, ladies and gentlemen. I've invested in a couple of them. Marico, for instance, I'm invested in there. At first, it was rural demand that was being subdued. Now that rural is improved and is showing positive growth, urban sector is suffering. It just cannot. FMCG just in 2024 is not its year. You take the auto sector and the picture is very mixed. While the likes of Mahindra and Mahindra, Hero MotoCorp and Ashok Leyland have shown profit growth in Q2, heavyweights such as Maruti Suzuki, Tata Motors and Bajaj Auto. Tata Motors and Bajaj Auto are two of my investments, Bajaj Auto being a very recent one. So, yay me. All showed considerable profit declines, which led to steep sell-offs in these names. Again, yay me. The theme is common across industries, with the exception of a few such as PSU banks and IT companies whose profit growth has been steady. So I just gave you some examples of FMCG and auto, but if you take a look at the collective sectors and multiple sectors of the Indian markets, Q2 has been bad. Q2 earnings is simply bad. So it's very clear that a lack of earnings growth and subsequent earnings downgrade have been a major factor in the sell-off you have seen in the Indian markets. Then there is the small matter of foreign institutional investors selling massively as they rotate from price to perfection India to far from perfectly priced Chinese markets. This has been one of those tactical trades which I'm not at all surprised by. I mean, one look at the valuation difference and you'll know why. Nifty 50 currently trades at a forward price to earnings of 23.6 times, whereas the Shanghai A-share index, Nifty equivalent, trades at about 13.3. So Nifty is nearly double. The valuation is nearly double of China. So obviously you have one that is overvalued with an earnings downgrade happening there to another which is undervalued, and you have stimulus measures there. So obviously the tactical trade, ladies and gentlemen, is just again not rocket science. When the Chinese government, like I said, announced a multitude of stimulus measures, FIIs jumped at the opportunity and rotated out of India into China. Now, I see this as a tactical trade. Like I said, I've told you multiple times, keep that in mind. This is a tactical trade, which means it's likely to be short-lived. But when you factor in the subdued Q2 earnings season, the reversal in this trade is going to take some time. As in the reversal from FIS from sellers to buyers and from China to India, that's going to take some time. November, for instance, has seen FIS maintain their stance as net sellers with 14,358 crores being sold so far. If I'm being honest, I do expect 2024 to end on a very subdued note for the Indian markets, especially if you take the FII's perspective. I don't think they will have any confidence going into the finish of 2024. Now, here's where these are all its doomsday scenarios. I've given you all the negatives. Now, do I really think the Indian growth story is it's coming to an end? Absolutely not in the slightest. I see this as a temporary setback rather than anything structural. Yes, earnings have been downgraded for many companies. Majority of companies, however, have indicated, especially the ones whose earnings got downgraded, have indicated with evidence that things are set to improve. Example, automakers had a stellar festive season, so the Q3 numbers should definitely pick up. And yes, one can argue that the overall growth has slowed down, with the government figures indicating India's FY25 GDP growth at around 6.5% to 7%, much lower than the RBI's own growth estimates. Here again, we are forgetting that the central bank has still not undertaken any rate cuts whatsoever. Despite living in a high interest rate environment, the fact that we are achieving a 6.5% to 7% growth is a very, very promising sign, a very, very positive sign. Thumbs up there. Yes, urban India is showing signs of slowdown, but there are signs that the slowdown that show that urban spending during the festive season has been very, very strong. YouGov's Diwali spending index last month, for instance, showed that urban India had the highest spending propensity in 4 years, with tier 1 cities seeing a 35% jump during this year's Diwali period compared to a 30% jump that they saw last year. And one should not discount the fact that we are entering the wedding season next month, which should also boost spending. Whoever's getting married, congratulations. But yeah, the wedding season's definitely on, so that should definitely boost spending. You know how we like to party. And then you have Trump's decisive win, which from a long-term perspective is likely to benefit India and is likely to stop the rotation from China to India. massive tariffs being proposed by President-elect Trump on China, there is a high likelihood of companies looking at India as their alternative manufacturing destination, which should drive investment and capex growth towards India. And given that India was very close to signing a trade deal with the US just before the onset of the COVID pandemic, the odds of a trade deal during Trump 2.0 is definitely more likely, given especially if you factor in the close relationship between Prime Minister Modi and President-elect Trump, which should shield India, hopefully, from any major tariff hit. Finally, despite the stimulus measures, the Chinese economy continues to suffer from a property crisis. So while FIIs now favor Chinese equities on purely on the basis of valuation, this is likely to be short-lived, as the Indian growth story very much remains intact. For existing investors like you and I, this is the kind of pullback that we've been waiting for. I did tell you I like this pullback. I did tell you at the start of the segment. I am not saying go all in, but I'm certainly saying that there are a number of sectors and companies that have become very attractive from a valuation standpoint. Yes, the Indian market continues to remain expensive. And I did tell you, I do see more pullback in the coming weeks. But these pullbacks, should they occur, actually scratch that, when they occur, in my opinion, would be a Christmas gifts and not Christmas nightmares. On that note, ladies and gentlemen, let's move straight ahead from India back to the US with the final segment, Doctors Dissects. And in today's Doctor Dissect segment, I'm going to take a break from AI stocks. I've been giving you a lot of AI names. I'm going to take a break from the AI stocks. I'm going to give you an industrial giant. I'm talking about logistics company FedEx, ticker FDX. FedEx Corp is the company, ticker FDX. It's making its comeback into the segment again. Now, been a while since I spoke about FedEx, but when I did speak about it, I mentioned how the company's cost-cutting initiative Drive has exceeded expectations so far, and how the company had delivered its targets under the program with clarity. Sad to say, ladies and gentlemen, my optimism was very short-lived during the latest quarterly earnings call. During the latest quarterly earnings call, management clearly highlighted that the cost-cutting results were below their expectations. Imagine, my timing on certain things has just not been right. Which, when combined with the macro challenges, resulted in the adjusted operating profit declining by 382 million in the most recent quarter. What was surprising is that the management continued to argue during the earnings call that they were on track to achieve $4 billion of savings through Drive in FY25 compared to FY23. This was attributed to the expectations that the cost reductions would build up quarter over quarter throughout the year, as well as accelerated savings that the company is projecting to see from Europe towards the second half of FY25. Now, I want to specifically take Europe as an example to demonstrate how management's bullishness may not be backed by evidence from the ground. Okay, I want to take Europe as an example. So we're talking Europe now. If one actually digs further into FedEx's European business, management has already planned a number of initiatives to prop it up. Examples include optimizing the line haul and the last mile density, improving G&A expense, and implementing dimensional pricing for European freight projects. Furthermore, the executive team, which handles the US surface business, is getting directly involved to optimize the European network, given that Europe is primarily a ground and freight business. All these initiatives are good, fantastic. However, both the demand and the economic growth in Europe are only starting to stabilize now, which suggests that it might take a while before growth actually starts to accelerate. A recent report by BNP Paribas supports this thesis. According to the report, while European economies returned to growth in the first half of 2024, households continue to prioritize building up their savings at the expense of discretionary purchases. This behavior is likely to be strengthened further by the fact that the bargaining power is ebbing away from the workers as labor market conditions loosen. While retail sales in Europe have started to increase again, with the exception of Spain, all other major economies in the region continue to see falling retail sales, with the likes of Germany and France seeing declines to the tune of 1.9% year over year. Overall, this report from BNP Paribas suggests that as far as demand and economic growth in Europe is concerned, it's a case of optimism rather than a proper turnaround. It is this lackluster demand that FedEx is likely to find the most challenging to overcome. So tell me, where's the evidence, right? Where is the evidence that they would get 4 billion in cost savings through, especially from Europe? Drive can certainly help in cutting expenses, but it's most certainly not a medicine for propping up demand. Moreover, given that one of the main factors which FedEx management attributed to the poor quarterly performance was challenging US domestic industrial economy, based on this logic, I simply struggle to understand how the company plans to revive its European business, given that one of the most biggest industrial powerhouses in the region, Germany, is expected to see strong headwinds in its industrial sector for the next couple of years. You see, absolutely no evidence. Although the big picture continues to remain subdued, the good thing was there was some positive catalyst for FedEx when it comes to Europe. However, I'm not buying this story from the management. The catalyst, if you really want to know, is the fact that the European road freight market is projected to return to growth in 2024, according to a report by Transport Intelligence. More specifically, the market is expected to grow by 1.6% in real terms in 2024, which is welcome news, especially after the segment contracted by 2.1% in real terms in 2023. In addition, according to a report by FTI Consulting, e-commerce sales in 2024 are expected to be more than twice the expected growth rate of total retail sales, excluding auto and gas, and more than 3 times the estimated store-based total sales growth. However, these projections will be dependent on whether households will loosen their purse strings in the holiday season, which, ladies and gentlemen, I find it extremely unlikely given their cautious stance. There has been a lot of emphasis by FedEx management on Drive, and the management has also been remarkably bullish on their ability to execute the cost-cutting program. In Q4 of last year, FedEx management clearly backed it up with results. The start of this year, complete disappointment. Yet, for some reason, management continues to remain upbeat about their ability to make up for the disappointment in the coming quarters. Based on the evidence coming out of Europe, however, in my opinion, the management simply has not factored in the challenges on the demand side of the equation. So I don't know. Let's see. But I'm absolutely not optimistic. I'm not an investor in FedEx. I just don't see it. Okay, I really don't see it. That's the first takeaway. The second thing I want to talk to you about FedEx is the fact that the major development from FedEx's Q4 report was the company's announcement that was conducting a strategic review of the freight business. The last time I talked to you about FedEx, I outlined the rationale behind why I think a freight spin-off would be the best outcome for FedEx, right? I did give you a lot more clarity on that. While I continue to believe in this argument, based on the most recent quarterly performance, the decision with what to do with the freight cannot come soon enough. A decline in weight per shipment and reduced priority shipments weighed in on the division's operating results. FedEx during the quarter completed the closure of 7 small market freight facilities. More changes are on the way for the segment, especially once the contract with the US Postal Service ends. Despite all these developments, it is high time that the management continues to completely focus on one FedEx and spins off the freight business so that the businesses can focus on their respective comparative advantage. Studies have shown that the productivity improvements gained from spin-offs are long-lived. Furthermore, the productivity gains were found to be due to cost savings, which fits the FedEx's Drive initiatives. There are already signs that the company may be planning for a freight spin-off. During the most recent quarter, the company announced several pricing actions to improve freight yield in the coming quarters, which suggests that the company would want to maintain the ownership of the freight business. Having said that, during the earnings call, management refused to shed any more light on the strategic review. Whatever the outcome may be, the conclusion of the review cannot come soon enough, as cracks are beginning to appear in the freight business. FedEx investors would be better off if that outcome is a spin-off. With that, I take my notebook, and you know when I take my notebook what it means. We are going to discuss valuation. Where is a blank page? When you need a blank page, it's not there. Seriously? Oh, there it is. Sorry about that. But I've got my notebook now. So, valuation. Let's go, right? Let's go. So, numbers. Company now expects FY25 EPS to come in between $20 and $21. Okay? as opposed to its prior guidance of a range of 20 and 22. So they've already slashed guidance. So FY25 EPS, $20 to $21 against the older guidance of 20 and 22. Given that the company expects the weakness in the industrial economy to persist for the rest of the year, and that the weakness in Europe, in my opinion, is not expected to dissipate anytime soon, I've adopted a very bearish outlook for the company for FY25. As a result, I've assumed FY25 EPS to come in at $20. So that's the low end of the company guidance. So that's my projections are that FY25 EPS would be $20 as opposed to my previous estimate of $22. According to LSEG data, the company currently trades at a forward price to earnings of 12.9. Okay, FedEx trails at 12.9. Trades current multiple is in line with its historical multiple, 5-year historical median multiple of 12.5, and its 10-year historical median of 13.4. It continues to trade cheaper compared to its peers such as UPS 15.2 and XPO 26.75 times. So XPO is clearly more expensive. I'm aware that one bad quarter doesn't necessarily reflect the company's long-term potential, but in the next 12 months, the reasons to be optimistic for FedEx, in my opinion, is very, very negligible, especially after also one factors in that the contract with the US Postal Service expires in the second quarter of FY25. I am also not convinced about the management's drive targets, as they simply did not offer a proper roadmap to achieving these savings during the earnings call. After factoring in all these elements, I have assumed a forward PE of 12.5x for FedEx. So my previous estimate was 14.1. Now I'm taking 12.5. So you have 12.5 multiplied by 20 gives you a price target of $250. So $250 and actually represents, sadly, a downside of about 14% from current levels. The new price target is a significant downgrade from my previous price target of 310, and there is significant downside from my current levels. Therefore, ladies and gentlemen, I am downgrading FedEx from hold to sell. So basically, it's a ratings downgrade alert here. My initial rating was hold. I'm now downgrading it to sell. This doesn't mean that I'm shorting the stock. All I'm saying is that new investors, in my opinion, need to stay away from this name. And this is a good level for existing investors to trim their positions and to take their profits or even completely exit the position. Bottom line, FedEx has started the year with a whimper. Both revenues and EPS were down year over year, and they also missed analyst expectations. Macroeconomic challenges in the US and Europe led the management to revise their FY25 guidance downward. While the Drive cost-cutting initiative continues to make progress, the progress is dramatically slowed down compared to the previous few quarters. FedEx management's confidence in reviving its European business is not convincing enough, since the macroeconomic challenges continue to persist in the region, albeit growth is slowly returning. The outcome of the freight business remains a mystery, and it doesn't help that the business is showing signs of weakness. Cost-cutting alone cannot help FedEx at this stage, ladies and gentlemen, especially when demand continues to suffer. Drive can certainly help the company generate savings, of course, but it simply doesn't have the power to revive demand. And no matter how much investors ride the momentum wave and drive the stock or whatever, the fact that Drive cannot prop up demand is a worry for the foreseeable future. That's all the time I have for you this week. Oh my God, I feel like time has flown this time. Too much of euphoric talking, then a little bit of dismal, a little bit of negativity around India, but then optimism. Time has flown away. Yeah, that's all I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I'll see you next week. Until then, stay safe and make some money.